What's up everyone, it's Vic Kirkiarian and welcome back to the channel. Today we're diving deep into the world of finance and real estate to understand a topic that affects us all, how the 10-year Treasury note impacts mortgage rates. Whether you're a seasoned homeowner, a first-time buyer, or just starting to think about real estate, this video is for you. If you find this video helpful, don't forget to smash that like button, subscribe to the channel, and hit the notification bell so you never miss an upload. All right, let's start with the basics. What exactly is the 10-year Treasury note? In essence, it's a loan that you as an individual can give to the U.S. government, and they promise to pay you back in full after 10 years. In return for lending them money, the government pays you interest. This is what's known as the 10-year Treasury yield. This yield acts as a benchmark for all sorts of long-term interest rates, including mortgage rates. And when yields are low, mortgage rates tend to be lower too, making it cheaper to borrow money for a house. But when yields rise, it pushes those mortgage rates up, making it more expensive to borrow. The 10-year Treasury yield is the puppet master behind mortgage rates. Lenders use it as a guide to set their mortgage rates. The government is a safe borrower, so the yield represents low risk. Lenders charge higher rates on mortgages to compensate for higher risk. This is why mortgage rates are often a percentage above the 10-year yield. If the 10-year yield is 4%, mortgage rates might be around 6%. When the 10-year Treasury yield goes up, mortgage rates follow. Now, you might be wondering what causes these 10-year Treasury yields to fluctuate in the first place. Why do they go up and down like a roller coaster? Well, a big part of it comes down to investor demand. Think of it like a giant auction. When investors have a lot of confidence in the economy, they're more likely to invest in stocks and other assets that they believe will grow in value. Treasury bonds, on the other hand, are considered a safe haven asset. Investors flock to them when they're worried about economic uncertainty or market volatility because they know Uncle Sam is good for his debts. So when the economy is booming, demand for treasuries tends to go down, pushing yields up. Conversely, when the economy is looking shaky, investors rush to the safety of treasuries, driving their prices up and yields down. Beyond investor sentiment, there are a number of economic indicators that can impact 10-year Treasury yields and consequently mortgage rates. These indicators give us a glimpse into the health of the economy and help investors and lenders make informed decisions. One of the most closely watched indicators is GDP growth. When the economy is expanding at a healthy pace, it usually means businesses are hiring, people are spending, and inflation is in check. This tends to push Treasury yields higher as investors become more optimistic about the future. On the flip side, weak GDP growth can signal a slowdown in the economy, leading investors to seek the safety of treasuries and potentially pushing yields down. Another key indicator is the unemployment rate. Low unemployment is generally seen as a sign of a strong economy, which can lead to higher Treasury yields. Now let's talk about the big dog in the room when it comes to interest rates, the Federal Reserve, also known as the Fed. The Fed is like the central bank of the United States, and it has a powerful influence over interest rates, including the 10-year Treasury yield. One of the Fed's main tools for controlling the economy is monetary policy. When the Fed wants to stimulate economic growth, it might lower interest rates, including the federal funds rate, which is the rate banks charge each other for overnight loans. This can make it cheaper for businesses to borrow money, invest, and hire, ultimately boosting economic activity. Lower interest rates set by the Fed can also indirectly influence the 10-year Treasury yield. When rates are low, investors may be less attracted to low-yielding treasuries and seek higher returns elsewhere, potentially driving yields up. Conversely, when the Fed raises interest rates to combat inflation, it can make Treasuries more attractive to investors, potentially pushing yields down. While economic indicators and the Fed's actions play a major role in shaping interest rates, there's another factor at play that's a bit harder to quantify: market sentiment and inflation expectations. You see, the financial markets are driven by human emotions, fear and greed. When investors are feeling optimistic about the future, they're more likely to take on risk, invest in stocks, and demand higher yields on their investments, including treasuries. This can push yields up even if economic data is mixed. Conversely, when fear grips the market, investors often flee to the perceived safety of treasuries, regardless of their yield. This surge in demand can drive yields down, sometimes even to record lows. Inflation expectations also play a crucial role in shaping Treasury yields. If investors expect inflation to rise in the future, they'll demand higher yields on their investments to protect their purchasing power, pushing yields up. Let's discuss how changes in mortgage rates, influenced by 10-year Treasury yields, impact borrowers. Rising mortgage rates can be a major obstacle for home buyers. Higher rates mean higher monthly payments, affecting affordability. A 1% increase on a $500,000 loan can raise payments by hundreds. Falling rates make homes more affordable, fueling demand. Lower rates can be a great opportunity to refinance and save thousands. When 10-year Treasury yields rise and mortgage rates follow suit, it can have a ripple effect throughout the housing market. As we've discussed, higher mortgage rates mean higher borrowing costs for home buyers, which can dampen demand. When fewer people can afford to buy homes, it can lead to a slowdown in home price growth or even a decline in some markets. This is particularly true in areas with high housing costs, where even a small increase in mortgage rates can have a significant impact on affordability. Higher mortgage rates can also impact existing homeowners who have adjustable rate mortgages or ARMs. These mortgages have interest rates that fluctuate based on market conditions. So when rates rise, so do their monthly payments. And this can put a strain on household budgets and potentially lead to an increase in mortgage defaults. However, it's important to note that the relationship between interest rates and the housing market is complex and influenced by a variety of factors, including economic growth, job market conditions, and housing supply. Now let's flip the script and talk about the benefits of lower 10-year Treasury yields and their impact on mortgage rates. When yields fall, it's like a breath of fresh air for the housing market. Lower mortgage rates make it more affordable for people to buy homes, which can stimulate demand and potentially lead to price appreciation. This can be especially beneficial for first-time home buyers who may have been priced out of the market when rates were higher. Lower rates can also be a boon for existing homeowners looking to refinance their mortgages. By refinancing at a lower rate, homeowners can potentially save thousands of dollars in interest payments over the life of their loan, freeing up cash flow for other financial goals. The combination of increased affordability and potential savings from refinancing can create a virtuous cycle in the housing market, boosting demand, construction, and overall economic activity. Throughout this video, we've primarily focused on the impact of the 10-year Treasury yield on mortgage rates, but it's important to note that there are other interest rates that can also influence borrowing costs, particularly short-term rates, short-term interest rates like the federal funds rate we discussed earlier are typically set by central banks and reflect the cost of borrowing money for a short period, usually less than a year. These rates can impact things like credit card interest rates, auto loans, and some adjustable rate mortgages. While short-term rates can fluctuate more rapidly than long-term rates, they generally have a less direct impact on mortgage rates. This is because mortgage lenders are more concerned with locking in their lending costs over the long term, which is why the 10-year Treasury yield is such a crucial benchmark. However, it's important to keep an eye on both long-term and short-term interest rate trends, as they can provide insights into the overall direction of the economy and potential future movements in mortgage rates. So there you have it, a deep dive into the fascinating world of 10-year Treasury yields and their impact on mortgage rates. As you've learned, these yields play a pivotal role in shaping the affordability and accessibility of housing for millions of Americans. By understanding the factors that drive yields, from economic indicators to market sentiment, you can make more informed decisions about your own personal finances, whether you're buying a home, refinancing, or simply planning for the future. Thanks for watching. If you enjoyed this video, please give it a thumbs up and share it with your friends who might find it helpful. Don't forget to subscribe to our channel for more insightful content on finance and real estate. See you in the next video.